Hello everybody and welcome to today's morning markets. Just before I actually get into the morning market video, I just want to remind you to please subscribe to our YouTube channel. So with that, you'll receive morning markets on a daily basis. You'll also receive the other videos we produce, such as our weekly podcast. I also just want to take that chance to shamelessly plug our weekly podcast. I'm on it tomorrow and it's all about intergenerational wealth planning. Okay, but let's get back to morning markets. And morning markets today really focuses on the US and US interest rates. And what we saw yesterday is the Fed raise interest rates by 0.75%. But look, what's the background to this? And this in some ways is very similar to what we've seen here in the UK, also what we've seen in Europe as well. So inflation is elevated. So if we look at CPI in the US, year on year to September, it's coming in at 8.2%. That's ahead of the Federal Reserve's 2% target. And that means that the Federal Reserve need to do something to cool inflation. And one of the key tools that they have is to raise interest rates. Now, as I said last night, interest rates went up to the target rate for the Fed's fund rate to 3.75% to 4%, so up 0.75%. What were expectations? Well, expectations were actually for exactly a 0.75% rise overall. I guess, when investors look at what's happening with interest rate rise or fall announcements, so central banks announcements, what we do is we pore over the statements to look for any kind of guidance or any hints as to what can happen with future monetary policy. So within the statement, Powell was quite clear, saying that the interest rate rises that they've seen so far will have a lagged effect on inflation and on the economy. Therefore, what they're going to do is potentially slow down the aggressiveness that we've seen within rate rises so far. So if you think since the start of the year, interest rates in the US have increased by 3.75%. So that is very, very aggressive rate rising overall. I think what is important though is what he did signal is that they are not looking to stop raising interest rates. So just looking at some of the language that came through from Jerome Powell. So one of the things he said is that there's some ways to go. So they were the exact words that he used. So our view is that the Fed they may slow rate hikes from here, but they're not seeing the type of inflation readings or labour markets easing that would lead them to stop completely. I think what else is quite interesting is Powell used the words, we can use our tools. So what do we take from that? So what we take is that the Fed maybe has more confidence in using the tools of cutting rates or actually stopping or reducing quantitative tightening to stimulate the economy rather than dealing with what is sticky inflation. But how did asset prices react? Asset prices react negatively. So US equities were down around 2.5% as at the close last night. And US 10-year treasuries, so US government bonds, yields rose. So they rose from around 4% up to just under 4.15% as at today. But what else is going on? There's a lot of central bank announcements, with the big one for us in the UK is actually today. So today, the expectation is that the Bank of England raise rates by 0.75%, which will be the most aggressive rate rise since 1989 that we've seen in one single month. As always, we'll keep you up to date with what's happening through morning markets. So please watch morning markets and also watch me on the podcast. Thank you very much.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.